Welcome to our opening panel discussion, Taking the Leap, Allocating Capital for Change. In this panel discussion, investors will shed light on the financial sector's need to collaborate to capitalize capital towards the systematic issues. In addition, the need to develop social standards and social impact measurements and management methodologies. We are pleased to be joined by Marie-Aimee Boury, Head of Impact-Based Finance at Société Générale, Vineet Sukumar, founding and CEO of Vivitri Asset Management, and Dave Zellner, Chief Investment Officer at Westpath Benefits and Investments. The panel will be moderated by Alessia Giangiacelli, Head of Knowledge, Community and Market Development at the EVPA. Enjoy the panel discussion.
So thank you, Chantal, and again, welcome everyone to this session, Allocating Capital for Change. And 2030 is almost upon us, but current innovative solutions tackling societal challenges are clearly not enough to meet the Sustainable Development Goals, and oftentimes these projects don't even have access to appropriate funding. So today I'm pleased to be here with the representatives of three organizations that are playing an important role to contribute to this collective challenge. So as said by Chantal, I'm Alessia Gianoncelli, Head of Knowledge, Community and Market Development, EVPA, the European Network of Investors for Impact. And I'm happy to welcome, again with few words, Marie-Aimee Boury. Marie is a finance professional with more than 26 years of experience. She currently heads the impact-based finance team at Société Générale, whose mission is to advise the bank's clients to improve the bankability and scale up of their business models using a unique impact-driven approach to deliver innovative funding solutions. So welcome, Marie. And then we have with us, as Chantal said, Vineet Sukumar, who is the co-founder of Vivitri Group, founded in 2017, and comprises India's largest debt platform. Vineet has 20 years of experience in financial services and is an industry expert in debt capital markets, performing credit, financial inclusion, and fund management. So welcome, Vineet. And then last but not least, welcome to Dave Zellner, who is the Chief Investment Officer at Westpath Institutional Investments. And Dave has more than 25 years of experience in the financial services sector. So I would like to start with Marie with a question, saying that going beyond mainstream renewable energy and financing and green bonds, Société Générale is pioneering an impact-based approach. So Marie, can you tell us more about the idea behind your impact-based finance and how does it work in practice?
Sure, thank you very much. So indeed, the bank, as many of you may know, Société Générale is very active, one of the leading banks in arranging renewable project finance for mainstream high-scale projects. But what we decided a couple of years ago is that there is a lot of financing opportunities and a lot of need of investments that contribute to the SDGs that currently our business lines do not address. And so the idea was to create a team, the impact-based finance team, that would focus exclusively on identifying solutions to bridge the Sustainable Development Goals funding gap. And maybe to start with and illustrate a bit more what is this impact-based finance approach, I would rephrase and not speak about a funding gap, but an investment gap, because after all, what is really missing is a pipeline of investable and bankable projects that directly contribute to the SDGs. So a couple of years ago, some estimates have been made about this funding gap, which was estimated at about $2.5 trillion every year if we want to achieve the SDGs by 2030. And more recently, the OECD has unfortunately increased that estimate to $3.7 trillion annual investment deficit towards the SDGs. So how do we reduce this investment gap, especially knowing that most of it is in fact consisting in investments that need to take place in developing countries, and probably more of half of it in Africa alone. So what we found by researching on this and trying to see how we can solve that major issue is that this lack of bankable, investable pipeline often results from a combination of three different hurdles. First, the business models are not adapted because the costs are too high. So work needs to be done by the businesses in order to reduce costs and achieve impacts and to address different impact needs from the populations around the world. Second, there's an issue of scale. Unfortunately, investments that contribute to the SDGs do not come in a multi-billion project, which would be quite easy for bankers to handle. But unfortunately, most of the investment come in small-scale, dispersed assets, such as access to energy through decentralized renewable energy power generation in rural areas, or access to water, or energy efficiency investments in developed countries. And the third hurdle is the risk misperception. Is in many cases many investors, in fact, would not consider investing in emerging countries because of the country risks and many other perception of risk by lack of knowledge that the investment is going to be too risky for them. And often the combination of those three hurdles makes those investments not investable. And the idea of an impact-based finance approach is, in fact, to help companies, our clients and clients to be, refocus their business models on impact, and seeing how they can combine their initial service or product offer to increase the impacts achieved. See how they can combine it with other companies' services and products, so they can mutualize the costs and therefore reduce the cost to impact. And also looking at aggregating transactions to reach a critical size that will not only make the transaction more attractive for investors, but also create diversification that is a first level of risk mitigation. And for the last part, which is the risk misperception, here, obviously, the data is going to be key. A lot of those investments don't have so much track record. So what we're trying to do is collect data and make sure that we use all the available tools like artificial intelligence and machine learning to extract information from past track record on transactions, information about their performance, of the assets, about the financial track record, the payment track record, as well as the impact achieved, to inform investors for the future similar projects, and to enable the scale up. So overall, the idea is really to work first on the business models, to refocus the businesses on achieving impacts, and by augmenting impacts, improving the profitability, the investability, and therefore bankability of those projects. And in a second step, look to use more traditional, I would say, financing techniques such as a credit enhancement and blended finance in order to bring those transactions in different type of formats, whether it's loan or notes, to the investor community. And maybe I'll pause here.
Thank you so much, Marie, for this interesting overview of the project and actually the concept behind what you normally do at Société Générale. And now keep on talking about impact businesses and solutions that need support and capital. Dave, can you explain how is Wispath investing for impact, and also what did motivate you to do so?
Thank you, Alessia. Sure, happy to. So I think it's important to start out by talking about our sustainable economy framework. We do believe, our organization, that in order to achieve the investment return assumptions that are expected by our participants and other stakeholders, that we need to have a sustainable economy. And we define that as social cohesion, prosperity for all, and environmental health. And our organization, so for those of you that aren't familiar with WestPath, we are the agency of the United Methodist Church that manages pension, health benefits, as well as institutional assets on behalf of about 100,000 participants and about 125 institutions affiliated with the United Methodist Church. We have about $30 billion under management. Of that $30 billion, we can trace $6 billion directly to impact. And I'm going to spend most of my time talking about one particular element of that program, but about $2 billion is directed towards firms that are managed by women and or ethnic minority firms. We've got about $2 billion in low carbon solutions. And we have other assets in agribusiness. But where I want to spend the bulk of my time talking about is our positive social purpose lending program. And this has been a program that's been in place for over 30 years. The way it began was back in the early 1990s when the chair of our investment committee, who at the time was the chief investment officer for the Ford Foundation, challenged our organization to invest more in alignment with the values of the United Methodist Church. At the time, the only element of our program that aligned with the values was negative screening. So we wouldn't hold securities in companies, alcohol, tobacco, weapons, that sort of thing. But he felt as though that the mission of the United Methodist Church is to transform the world, and negative screening really doesn't do much to transform the world. And so what we need to do is to deploy capital in a way that would be transformative. And he invited, at the time, the investment committee and the staff to visit Harlem, which is north of New York City. It's a very impoverished community in the northern part of Manhattan, to see the dire need for affordable housing at the time. And so the committee witnessed the problems in that community and the extent and the need for affordable housing in the community. And they authorized a very nominal investment to support affordable housing. At the time, it was $25 million. But over the last 30 years, we've deployed over $2 billion in capital for affordable housing. And now I will say that the vast majority of our capital is in first mortgage loans. In the United States, there's a program called the Low Income Housing Tax Credit Program. It provides incentive for the equity investors to invest in affordable housing. And so what we do is we provide the debt financing. And I'll talk a little bit more later about the Low Income Housing Tax Credit programs and the inherent advantages to our organization and other debt investors. But essentially, it allows debt and equity investors, as well as grant money, to come together to finance particular projects. Now, most of our projects are geared towards low and moderate income families, but there are specialized projects that we have funded over the years, and I'll highlight just a few. In Los Angeles, there's a 64-unit complex called the Dolores McCoy Housing Facility. And it is primarily designed for women who have been previously incarcerated, that have families that need to make that transition back in from having been incarcerated back into the workforce. Another project that we funded is in New York, about, again, another 60 units. Half of those units are dedicated for people that are working with the New York mental health program, and another half for people that are hearing impaired. We have another project in Cleveland, Ohio, which is geared towards members of the LGBTQ community, the low-income community in the Cleveland area. In addition, we have funded a homeless shelter in the Bronx in New York for well over 100 beds for people that are transitioning from being homeless back into the workforce. So it's a number of very needed types of facilities, types of projects to support people that are marginalized in the United States. And it's something that we have taken a great deal of pride in. Now, it's important to say that all of the loans that we initiate are market rate. And we are long-term holders, so that when we make a loan, the intent is, and we nearly all the time hold on to those loans for the entire period for which they were contracted. So Lesia, that is the background in the types of investments that we're making through our positive social purpose lending program, and I'll be happy to talk about it a bit more later in the panel.
So thank you so much, Dave. Impressive to see all the different projects. So I think that now we can go from a long-standing organization such as WISPATH to a most recent one. So Vineet, you refer to it as the financial platform of the future. So can you tell us what are the peculiarities of Vivriti Capital? And can you also give us an insight about your upcoming impact debt fund, which seems to be pretty unique?
Thanks, Alicia. And very glad to see all of you here. So I represent a group that started 4 years back with the objective of enabling access to debt for enterprises in India. Now, India has been a fast upcoming emerging market, but even today, India is a country with a per capita income of $2,000, right? And even there is a significant divide between the haves and the have-nots. Our objective and our mission as Vivriti is to build access to capital markets and build access to debt for enterprises, especially the small and medium enterprises of our country. And to that end, we have built today one of the largest marketplaces for fixed income, through which we bring in large pools of capital from international markets, from domestic markets, through our digital marketplace to provide access to debt to such enterprises. The forms of debt could be loans, it could be bonds, it could be securitizations, it could be trade finance, but it's necessarily packaged in a way that meets the need of these small enterprises. Now, as a result of working in a country where the per capita itself is low, and also working within a relatively disadvantaged segment, our work is extremely impactful. Today we work with more than 1,500 enterprises, enabling much needed access to debt. We have in the last 4 years enabled $9.5 billion of debt to such enterprises, and along the way created tremendous impact. I'll just kind of go through some of the numbers. In the last 4 years, we have supported directly and indirectly through supply chain financing more than 1.2 million agri-ventures and livestock farmers. We have enabled more than 300,000 affordable housing loans. We have enabled access to debt to more than 47,000 schools. We have enabled indirectly access to finance to more than 1.6 million women entrepreneurs across rural parts of India. We have enabled 100,000 emergency and health loans, and we have enabled more than 20,000 loans for sanitation, for building sanitation, right? Now, how do we do this? We do this by identifying very good quality enterprises Now, by definition, small and medium enterprises are difficult to access. You heard Marie-Aimee on the challenges on accessing good quality companies that can be the harbingers of impact. Now take that problem and multiply it 100-fold, divide it across the length and breadth of India, and you understand the problem, right? So we take it upon ourselves to find these enterprises, to use a lot of digital sources of data to access and authenticate their financial information, authenticate their business data, and use that to build confidence in the investor community that these enterprises are actually worth lending to. So we form the bridge, and it's an extremely important bridge, because that's what lends a lot of confidence to the investment community, to be able to provide necessary financing to these enterprises of the kind that they need. They need working capital. They need to they need to pay their creditors. They need to buy inventory. They need to meet operating expenses. They need to grow, build their ability to generate capital as well, and meet shareholder returns. And that's what makes these enterprises sustainable in the long term. And that's what we are setting out to do. We today work with more than 500 domestic and international investors in our efforts towards meeting our mission. And over time, we have realized that while we have built, at least what we think is a great platform, and which has been significantly scalable, but there will always be very large international pools of capital that really cannot access our platform every day. And to build their access to our work, we have set up an asset management company that has launched multiple debt funds that can pool in capital from the Western world, from other parts of Asia, and bring that towards India to meet our costs, right? So in that regard, we have launched a fairly large impact fund based on the areas that I just outlined. To our mind, we should be able to provide very, very, very meaningful access to such investors who are working with us in this fund to the kind of costs I outlined in India. So we have done some work on this already. Today we as a fund house have around $200 million of assets under management, where each and every fund is mapped to multiple SDGs and reports accordingly to investors who work with us. And that's exactly what we will follow for our upcoming fund as well. Alicia, back to you.
Thank you so much. It was very interesting, and I heard a lot talking about data, but also funded tailored to the needs of the enterprises, the word of transformative change, attract capital, and blended finance. So I would like to ask Marie, since we all acknowledge that systemic change can really happen only when working together, and since one of the main roles of Société Générale impact-based finance is to build an impact-based ecosystem, can you tell us a little bit more about the catalytic role that you play in the markets, Marie?
Sure. So yes, to pick up on what I said previously and the examples given by Vineet and Dave, it's obvious with that given the amounts at stake, the annual trillions of investment gaps that need to be invested if we want to reach the goals by 2030, we absolutely need a disruptive approach. We cannot continue business as usual. We cannot just do incremental innovation and move a little bit the needle. What is needed is really a disruptive change. And if you want to enact a disruptive change, you need a catalyst. You need to have some actors in the different parts of the economy, the different systems, that is going to play this this pioneer role and incentivize and push people to go beyond what they're doing, beyond the business as usual. So that's what our group is doing within the bank. And in fact, we're trying to be a catalyst at 3 levels. So first, as I was saying, inside the bank, by working with the different business units and business lines and coverage team of the bank to explain our approach. So some internal, I would say, education, awareness, help them understand what are the specific impact issues related to their clients or their transactions. And for this, we're using the Positive Impact Finance Framework, which is a method to identify and assess impacts that have been developed, co-constructed within the UNEP FI initiative together with banks and corporates. And it's got a very simple definition, which is a positive impact finance investments is one that has at least one positive impact on at least one of the 3 pillars of sustainable development: the people, planet, and prosperity. And it echoes very well what David said just a moment earlier. And, which is a very important addition, that also identifies and properly mitigates negative impacts. Because often we go on focusing on positive impact, but we don't do the whole holistic approach to make sure that all negative impacts have been properly identified and assessed. So with this guidance, basically, we're trying to educate our front office people, our coverage bankers, to help them have these conversations with our clients, and for the business lines to look at what are the new markets where they could provide solutions given their skill set, and that go beyond the mainstream business as usual markets. So if I take just a simple example, as I was saying, we're one of the leading arranger in renewable energy project finance. But if we look at access to clean energy in developing countries, in particular in rural areas, you see that approximately 900 million people in the world don't have access to electricity. And for this, one of the most impactful solutions is to install mini-grids, so decentralized, small-scale solar plants that, of course, are, as I was saying earlier, small-scale, so not as attractive to finance as a large-scale 100 megawatt, $100 million project. They are dispersed in various rural areas, so it's not as easy as one big chunky project in a single place. And the customer base for those projects is not your traditional off-taker, which will be the national utility, where you can find ways to mitigate its credit risk if it's perceived as too risky. It's going to be a large number of small-scale customers. Some of them are individuals, and some of them are small enterprises, which will be able to completely change their way of living and change their business thanks to the access to electricity. So this business is estimated to be a potential market of over 120 billion in the next 10 years in sub-Saharan Africa alone. So that's a very significant market. But when we talk to our colleagues from the project finance renewable energy team, this is something that is very far from, even though they have all the technical skills to address it, very far from the guidelines they have for origination of transactions. So that's one example where we're working currently to see how we can find aggregators for those assets. So the aggregators can be the developers who have won a bid to install a program of, let's say, 50 or 100 mini-grids. So that starts to make a more sizable investment proposition where the debt size is going to be worth putting the work of due diligence and structuring. Or the aggregator can be a DFI, for example, that has issued a program to a result-based finance program, for example, and on which they can bring in a private investor. So first level of catalyst is inside the bank to change our business, to progressively change the type of loans we are originating in order to increase the positive impact and reduce the negative impact. Second level, of course, is with our clients and the whole ecosystem of like-minded, impact-driven companies that may be large groups or SMEs, startups, NGOs, social enterprises, public entities, municipalities. As you all know, most of the population is and is increasingly going to live in cities. So helping municipalities design multi-impact projects and increase the efficiency of the public money they're going to invest is, of course, of the utmost importance. And so what we're trying to do is identify those companies that are first movers, that have already switched their business model to not only look for profits, but also for impact. And we are proposing our services to help them finance those projects and also to put them together. In some cases, we help augment a project by putting in contact different companies. So again, taking the example of a mini grid. So we're currently helping an SME and developing a mini grid program in West Africa. And they had issues with the supply of batteries that was not able to deliver. So we managed to put them in contact with another client of ours who is providing batteries which are highly resistant to the heat. And they also had a problem of connectivity in those rural areas. So we also brought in the right person from a large telecom operator that is client of ours that precisely had a program to access rural areas, and putting them together enabled the project to have more strength and to have more chances to succeed. And I would say the last level where we're trying to be a catalyst is in collaborative initiatives. So there are many of them. So we're trying to pick the ones that are most relevant and where we can help by bringing our ideas, but more importantly, where we can also tap this collective intelligence and listen to what others are doing in order to accelerate this convergence that is really badly needed towards a single common language around impact and help companies act on it. So, for example, I mentioned the UNEP FI Positive Impact Initiative, but we're also very involved with the UN Global Compact CFO Task Force that aims at mobilizing CFOs to bring their company, to accelerate their company's transition to a SDG friendly or contributing businesses, and many other initiatives like this, where we're trying to again push the boundaries and bring ideas to work collaboratively.
Thank you, Marie, also for offering the concrete examples of the mini grid. So everything is settled in practice. And maybe to continue to discuss about collaboration, Dave, can you tell us more about the process you follow to source your investments? And also if you can give some insights on the challenges that sometimes you face when deploying your capital.
Sure, Alessia. As I mentioned last time I was speaking, we've deployed about $2 billion in capital over the history of the program. And I should mention that, as I mentioned before, all of those are market rate loans. And the way we go about setting our rates is we start with a risk-free rate. And then what we'll do is we'll assess the credit associated with the loan. And we'll look at typical underwriting type characteristics. The loan relative to the value of the property. What's the percentage of the loan relative to the value of property? To what extent is there sufficient debt service, to sufficient cash flow to service our debt? We also look at credit enhancement. In addition, as I mentioned, we hold these loans for the entire term. They are not marketable, and so we require a spread for liquidity. Now, once we establish the rate, then we can assure that we are achieving, that we're in line with what the market is, the market would bear. Over the course of our program, we've lost $1 million. And so on $2 billion, that translates to 5 basis points. And I think most bankers would tell you that a 5 basis point loss on a $2 billion portfolio is pretty good. But the way we do that is we don't have the resources to source our loans directly. So we don't have borrowers coming to us asking us to borrow. We work through a network in the United States, something called a Community Development Financial Institution. So we have relationships with about a dozen community development financial institutions. Most of them are nonprofit, although 1 or 2 operate for profit. Now, oftentimes in the United States, you have a developer, a builder, who has a vision, but just doesn't know how to navigate the bureaucracy in this country for building an affordable housing project. What really makes the economics work is to utilize what I mentioned earlier, is the low-income housing tax credit program. This is what provides the incentive to the equity investors to invest in the program. Basically, the low-income housing tax credit program reimburses the equity investor for all of the equity that has been put into the program. And so the Community Development Financial Institution works with the borrowers to meet all the requirements of the Low-Income Housing Tax Credit Program, meet the requirements of the state in terms of building, zoning requirements, building requirements, a myriad of requirements in order to build a low-income housing project. And also, they provide those developers access to capital, not only the equity investors, but the lenders like ourselves. And then also, oftentimes, there are grants that are required to make the projects work. Now, Marie-Aimee talked about some of the work that her bank does, which is providing credit enhancement. And we too require credit enhancements on the loans that we fund. Every loan that we fund, we require that there is some credit enhancement associated with that loan. Now, sometimes those come from state insurance agencies. Sometimes it comes from Fannie Mae in the United States, which is a federal agency. But oftentimes it actually comes from the Community Development Financial Institution itself. This is how we ensure that they are effectively administering our underwriting standards. They have skin in the game, and often they agree to take a 10% first loss position on any loan that we make. So we will be participating in the loan with the Community Development Financial Institution. So for example, if the loan is for $5 million, the Community Development Financial Institution will put up $500,000. We put up $4.5 million, and if there is a loss, that first $500,000 of loss goes to the Community Development Financial Institution. So they are very incentivized to ensure that they are adhering to our underwriting standards. Now, in terms of challenges, the Low-Income Housing Tax Credit Program is relatively new in this country. It's been around for about 35 years. And at first, because it was new, people were reluctant to utilize that program from a lending perspective because there was no track record. But I mentioned our experience has been about a 5 basis points of losses. And across the entire industry for lenders, we're at the low end of the range. It's been about 5 to 10 basis points. So now banks and other lenders have realized that it is a low risk program. And so we're seeing a lot of competition from banks in particular, because there's a program in the United States called the Community Reinvestment Act that requires banks to invest in their local communities. So they will be more likely to offer lower rates in order to meet the Community Reinvestment Act requirements. So we've pretty much carved out a niche in the $1 to $5 million loans range. Banks tend to want to make larger loans. The other niche that we occupy is for projects that need to be developed, that need to be built. And so what happens is that the borrower comes to us for a forward commitment saying that we will not fund the loan until after the project is built, which could be 24 to 36 months in the future. Banks tend to want to deploy the capital immediately and not wait for a project to complete 24 to 36 months. And so that's a niche that we've carved out that we are funding. So recognizing that we just have a few minutes left, Alicia, I'll turn it back over to you.
Thank you so much. And actually, I have the last question for Vineet. And since afterwards there are a few polls before to close the session, and Vineet, you mentioned already some indicators of impact, I would like to ask you whether you can be concise, but explain us a little bit more about your detailed impact assessment, and then we can have the polls that relate a bit to that. So the floor is yours.
Thanks, Alicia. In our work, we handle the measurement of impact and also the communication of impact, as well as the integration of impact into product design in two ways. Measurement is easy. We engage with each and every issuer in specific domains of work to identify what could be the impact indicators that we need to measure. We put in place a very, very clear project plan for us to be able to measure this. In case those metrics do not exist at the point of investment, we provide some time, but we do need to make sure that at a point of time, such impact measurement has to commence and then be maintained throughout the life of our investment. Given that we are extremely focused on credit and on risk management, impact measurement and conducting an audit on the data is as much an integral part of our risk management as is the measurement of financial data as well as business performance itself, right? At our level, we integrate this data, which then provides the basis for reporting to investors on the platform or investors into a particular fund that we are running. That can give them a very clear sense of what exactly they have invested into and what's the impact of the investment they are holding. Now, when it comes to product design, however, there are two approaches. One approach is that we create, let us say, a blended product, which could be a mix of various categories of SDGs that are being met with their individual metrics that are coming in from individual companies. Now, this is typically the approach we would use for a blind pool product, where there are very granular requirements for diversification, sector allocation, etc., etc. The second approach is where we work with very large pools of capital to co-create the product, right? Now, here we have had some very, very, very interesting conversations, and let me take a couple of examples to illustrate. We are designing a product that will focus only on India's emerging infrastructural needs that are relevant to relatively lower income households, as well as relevant to the journey that India has to take towards becoming more focused on renewables. And so this particular fund will invest in primary healthcare. This fund will invest in diagnostics. This fund will invest in agricultural warehousing, in creating capacity for agricultural warehousing. This fund will invest in building digital infra that connects SMEs to modern payment systems and lending systems. And these have been shortlisted in discussion with the specific investor who's working with us on this particular product, right? We're creating a second product that will only focus on bringing retail asset-backed securitization out of India to global markets, right? And such retail asset-backed securitization would focus on financing that is going to low-income households, financing that is going for small enterprises, financing that is going for affordable housing, financing that is going to build a credit score for individuals who are new to credit, right? And packaging this into a vehicle that would offer those kind of retail loans to global investors. And our assessment is that we can achieve a scale of more than 300,000 such loans packaged into one fund that achieves a size of around $250 million, right? A third product that we're coming out with is focused entirely on healthcare and post-COVID infrastructural requirements at India's healthcare system, right? So these are just examples, and there are many more such opportunities that we are today engaging with large impact funds, foundations, as well as, very interestingly, very large commercial fund houses that today are also searching for such opportunities where finding impact would not necessarily mean sacrificing return, right? And where impact is coupled with world-class risk management and structuring as well as reporting, right? So that's kind of how we are doing it. And given the kind of interest that India has seen, we are very hopeful that our work will scale up well.